Welcome back. Cash flow is a major concern for most small businesses dealing with a lag between sales and payments. If this predicament, it is with this predicament that has led to the birth of a financial service called invoice discounting. I'm joined in the studio by one of the industry's biggest players. In fact, they're North America's largest alternative funding source for small business. David Hector, or is it Hetchter, the Managing Director of Interface, joins me in the studio. Pronunciation, Hetchter or Hector? Hector, yes. Okay. Now, David, tell us about Interface, the company.
Yeah, sure. Interface Financial Group is a business that does invoice discounting, or a product that's called spot factoring. And essentially what that does...
Sounds like American spot factoring.
Yeah, it's good for marketing, isn't it?
Yeah, fantastic.
But what it is it provides clients, and generally small to medium-sized businesses, with short-term working capital finance. And we do that through acquiring a selective group or single invoices from small businesses.
Okay. So basically Interface is an alternative funding source for small business. Is it the largest alternative in America? Does that mean it's, rather than going to a bank for traditional finances, the next would be alternative, and that's you
That's
guys?
us. That's
okay.
correct.
All right. So is it a listed American company or
it's a private company?
Private company.
Yes.
And how long have you been in Australia for?
We've been in Australia since 2006, but we really started to ramp up the growth last year. And we've been really the company's history. It's about 40 years old. Started in the U.S. and Canada. It was 5 years ago that the business expanded into New Zealand, actually, and that business has grown nicely with 12 offices now. And the time was right to then cross over the Tasman and to grow the business here in Australia.
Okay, so. Do you think a lot of small business people don't really understand this? It seems like voodoo economics, that someone will buy your invoice, or people seem to do it when you know what's hitting the fan. They say, what can I do? And the banker might say, well, have you thought about doing this? So explain in a nutshell what happens in the process.
Yeah, certainly. It's absolutely true, Peter, that most small businesses don't know about this, and generally they will turn to the bank, who will often say no because they don't meet the criteria. They'll start using credit cards, which can be problematic. And what they don't recognize is that they have this asset, and the asset is the accounts receivable or the invoices that they generate. The fact of the matter, it's an asset. It is an asset, and they don't utilize the value in that asset. The challenge. It also goes to the strength of that accounts receivable. Often, that small business is providing a service to a larger business. The small business's credit may not be very good because they're new, because they're small, they don't have the assets. The large company that they're dealing with, who they're providing the services to, has a better credit rating than they would. And essentially what invoice discounting is you're taking the risk, looking through the client, the smaller business, to the larger company. Yeah,
I can remember an example, I think it really sums it up. There was a woman who had a baking business, and she cooked terrific cakes, and it came under the notice of David Jones. So all of a sudden she was given a massive demand that she'd never had before, and she was worried about her cash flow. Now, she found it very easy to go to an invoice discounter because they'll getting assets written on David Jones's books, and they just still happen to do it. Now, the end result was that she had to pay some sort of discount for it. So give us an idea. If someone has, say, a $10,000 invoice to a really good, reputable brand like, say, for example, David Jones, what would they lose off that $10,000 in shifting it to you guys?
Certainly. The way that our product works is that it's very much driven by the number of days that are outstanding. The invoice is outstanding. So we have what's called a daily discount rate, and what that allows the client to understand is that the number of days will just be the daily discount rate times the number of days outstanding. And what that gives them the opportunity to do is to say, well, in that situation, David Jones, okay, I know they're going to pay in 30 days. So I know that the cost of this product is going to be 30 days times the daily discount rate. In some cases, that might be 4%. It might be 4 to 5% of the invoice, depending on perhaps the size of that invoice. Okay.
Is it in their interest then to try and sell you the invoice when there's only 10 days to go, because then effectively you're only offering 10 days worth of finance before the money comes in?
Well, the way that we operate is we want to motivate them to use us when they need it. It'll motivate them to use it. Well, the cost will be quite small for them to do it, but they may need to do it because there's a supplier that they absolutely need to pay.
Yeah.
They may need to be able to they need that cash in order to unlock supplier discounts. And so we're fine with them, using us in that way because one of the benefits of our product is that we offer that flexibility. They can come and go as they like in terms of the use of that product. And as a result of there being no penalty for them stopping the use of our product, what we want them to do is to use it when they need it, and then they'll come back and use it again.
Clearly, if someone's watching this, they'll still be saying to themselves, well, roughly what kind of percentage do I pay to get involved with invoice discounting? And I presume it varies according to the riskiness of the creditor,
Yep.
in this case, or debtor in this case. Can you give us a range of sort of effective interest rates that someone pays or loses to get involved in invoice discounting?
Yeah, sure. Well, I guess the first thing is that you have to look at when you're comparing this to other products, you have to look at it in comparison to what other fees there might be.
Yeah.
Okay. With us, we try to be very transparent in terms of the cost of us. It's just the cost of the discount to the invoice. So there are no startup fees. There are no account keeping fees, and so they know that on any particular invoice transaction that they do with us as to what it's going to cost them. So I think just to answer the question, generally what they would be looking at in terms of the cost is that if they were using the service for, say, let's say there was 30 days that the invoices were open or outstanding.
Yeah. Not actionable. Yeah.
Right.
Yeah.
Then they'd be looking at, it could range between, anywhere between, say 3 to 5%, which would be the gross margin that they would forego as a result of using the service. Okay. And now the key for us is again, because the service is use it as you need it, and you only pay for it when you're using it. It's generally, we're attracting the kinds of customers that need it on say a seasonal basis. I guess, Peter, I generally sort of, when I look at my customer base, the analogy that I use is it's a bit like the churchgoers. You get the regulars, okay,
Yes.
and again they'll come to us for, again, single or selective, but on a regular basis because they have particular customers. Generally, the larger ones might, again, use your example, the David Joneses, or we've got a bit of a sweet spot in the mining services. The larger mines, because they take longer to pay, they'll be ones that are good to use. The next group is what I call they're the C&E crowd, Christmas and Easter. I know that as a result...
You are a religious man knowing this sort of stuff, yeah.
But generally, the analogy is that I know that because of the seasonality of their business, that they will have cash flow spikes, a cash flow pinch, and our service works well because I'm not putting a minimum usage period on them, and if they need to cash up before Christmas, that's fine. They can, but they're not paying for the service when they're not using it. And of course, the other one is when a company that might be going through a hard time. They're just going through a difficult patch, and they just need us for perhaps the bridging to get them to a recapitalization.
And I guess in terms of those businesses that can go through a tough time, the best time to build a relationship with you would be when the business is actually booming, and just say, look, I'm a boomer. And I guess that's another threat. When businesses are growing quickly, that can be a threat to them as well, because they're growing really quickly, they're paying out all the time for their staff and their suppliers, but the big customers might be slow payers, particularly if they're government payers as well. So is that would you recommend that people get to know you guys or your rivals before anything like what hits the fan?
Yes, yeah, absolutely. And what we want to try to do is to minimize the barriers that clients have in order to start using us. And I think that's really where we differentiate, because we're saying there's no cost, because there's no upfront fee to get set up. It's not like there's a cost to you. And then when you're ready to use it, then come and use it.
Okay. It all sounds good, but what can go wrong?
Okay.
The people at the moment who don't know enough about this kind of finance, what can go wrong?
Okay. Well, the first thing that can go wrong just comes back to the core business that a client is in. If they have very low margins and unsustainable margins, then our form of finance is not going to help them for a long period of time, because it will just eat away.
On death row.
Exactly. So if a company's in that situation and they're looking for invoice finance, it's not going to work. We're looking for the win-win. So that's the sort of thing that can go wrong. The other thing is really back to what we were talking about before, where sometimes, in terms of the quality of the debtors, sometimes what customers, when they talk to us, they think, okay, I've got a very difficult debtor. It isn't someone like a David Jones or someone who might take longer to pay, but it's somebody who's difficult. Will you buy it? And we say, no, we're not there to buy distressed debt. And so if they're trying to sell an invoice that's from a customer where they're questioning whether or not they're actually going to get paid, it's actually going to result in it being more expensive because of the fact that it's going to be outstanding for longer, and it's just a bigger headache.
Okay, what happens if they sell you a debt of a well-known company that goes bankrupt? What happens then?
Okay, well, if the company goes bankrupt that actually owes the money, then our product is what's called a recourse product. The reason why we only buy single or selective invoices is we make sure that there are enough other invoices that they have or accounts receivable in case it goes bad. And so we are really looking at the total quality of their book, even though we're only offering finance to part of it. But as part of the risk, we're looking to understand that there might be recourse to being able to do another transaction against another part of their book.
Okay, but the simple, I guess I'm getting to this. If you're unable to get the money back, does that then go back to the small business that's locked in with you?
It does.
Okay, yes. So the strength of the debtor is going to be important in this transaction. At the end of the day, you guys stump the finance up on the belief that it's a good debtor, but if it ends up being a bad debtor, it does come back to the business.
That's right. Yeah. That's right. I mean, again, there are many situations where we can recognize their household names that they have invoices to. In other cases, there's very substantial, medium-sized businesses out there that we may not recognize. And really, what we're trying to do with the recourse aspect is to make sure that in that transaction with the small business owner, that they will stand behind the paper that they are selling to us.
Okay. Fantastic, mate. A good explanation, and best of luck with it.
Yeah, thank you very much.
Okay. So, after the break, we'll be talking to a guy who's coming up talking to you about an online model for financial advice for managing your super. But first, here's how the blue chips fare today.